India is not yet in a bear market. It is down around 12% from its peak if you look at the Nifty, but other markets around the world, particularly the US, are in bear markets. So if you look at the Nasdaq Composite, that is down 28% from its peak of around 16,000. So if we do indeed follow the Nasdaq's example and head into a bear market, how long does one last and what do you do in it? So let's address the first question first. How long do bear markets last? Of course, there is no way to predict this, but we can look at historical examples. For example, the last bear market triggered by the COVID-19 pandemic was an exceptionally short one. It lasted just about 7-8 months. If you go further back, you will see that India has had longer bear markets. So, for example, we had a bear market from March 15 to April 17 after the stunning rally of 2014 and 2015. And that one lasted 24 months, although it was quite shallow. Then before that, we had another bear market from Jan 11 to September 13, and that lasted 33 months. In fact, the longest bear market we've had so far was in the 1990s, and that bear market went from September 1994 to July 1999. It followed the Harshad Mehta scam and it lasted 59 months. How about internationally? So if you look at the S&P 500, for example, once again the COVID-19 correction and the bear market that followed was just a 6-month affair. But if you go further back and look at the bear market that followed the dot-com bust, that lasted from September 2000 to April 2007, 80 months. A lot of investors in the current stock market might have never seen a bear market in their lifetime. A recent speech by Finance Minister Nirmala Sitharaman said that there were around 4 lakh Demat account openings per month in financial year 1920. This grew to 12 lakh Demat account openings per month in FY21. This further grew to 26 lakh Demat opening accounts per month in FY22. So a lot of people who've entered the market in the financial years 21, 22 would have never seen a bear market in their lives. So what do you do in a bear market? The first thing you can do is recalibrate your goals. If you have planned for a goal that assumes a fairly high equity return of 10-12%, you may have no choice but to reduce your expectations. The second thing you can do is change how you will reach those goals. So if you had earlier planned an 80-20 split between equity and debt, perhaps you could skew it more towards debt to get there. And last but not least, you simply need to have patience. Just like bull markets come to an end, so do bear markets.